Ever wonder how long it takes for your money to double? What if there was a quick trick to figure that out without using complex math? That's where the rule of 72 comes in. Want to know how you can grow your savings faster and make your money work harder for you? Stick around, and we'll explain how this simple rule can transform your investment strategy and your future wealth. What is the rule of 72? The rule of 72 is a simple way to estimate how long it will take for your money to double based on a fixed annual interest rate. It's like having a financial shortcut at your fingertips. Here's how it works. You take the number 72 and divide it by the interest rate you expect to earn on your investments. The result is the approximate number of years it will take for your money to double. For example, if you're earning 6% interest on your investment, you divide 72 by 6, which gives you 12 years. That means your money will roughly double in 12 years. Pretty cool, right? Now, why is this useful? Well, for anyone planning for the future, whether you're saving for college, retirement, or even that dream vacation, knowing how long your investments take to grow helps you make smarter decisions. Why the rule of 72 matters for your investments. The rule of 72 isn't just a neat trick. It can make a real difference in how you plan your finances. Here's why. Quick estimate for long-term planning. Instead of getting bogged down by complex financial calculations, the rule of 72 gives you a quick snapshot of your investment growth. It's especially handy when you're comparing different investment options. Whether you're choosing between a high-risk stock or a safer bond, this rule can help you see how quickly your money will grow based on different interest rates. Inflation check. Inflation eats away at the value of your money over time, but the rule of 72 can help you understand just how fast that happens. You simply divide 72 by the current inflation rate, and you'll know how long it will take for the purchasing power of your money to have. For example, if inflation is at 3%, your money will lose half its buying power in 24 years, 72 divided by 3. If inflation spikes to 8%, that time frame drops to just 9 years. Motivation to start early. The earlier you invest, the more time your money has to double. Using the rule of 72, you can see how crucial it is to start building your wealth sooner rather than later. Time is your best friend in the world of investments, especially with compound interest working in your favor. Applying the rule of 72 to real-life scenarios. Let's break this down with a few examples to show how the rule of 72 can work for you. Example 1. A 4% investment. Imagine you invest your money in a savings account that offers a 4% return annually. You divide 72 by 4, which gives you 18. This means it would take 18 years for your money to double. So, if you put $10,000 into that account, after 18 years, you'd have $20,000, and after another 18 years, you'd have $40,000, just by letting your money sit there and grow with interest. Example 2, a 10% return on stocks. Now, let's say you invest in stocks with an average return of 10% annually. Divide 72 by 10, and you get 7.2 years. That's right, your money doubles in just over 7 years. In this scenario, that same $10,000 investment could become $20,000 in just over 7 years and grow to $40,000 in around 14 years. The difference between 4% and 10% is huge. This is why many young investors lean toward higher risk, higher reward investments when they have time on their side. The rule of 72 shows how fast those rewards can come. How the rule of 72 affects your financial strategy. So how do you use this rule when making financial decisions? It can guide you in 3 key areas. Number 1, choosing the right investment. The rule of 72 can guide you in making smart investment choices by comparing different rates of return. High-risk investments like stocks typically offer higher returns, but also come with greater volatility. For example, a stock investment that averages 10% annual returns will double your money in roughly 7 years, but it comes with market ups and downs. On the other hand, low-risk investments like bonds or savings accounts offer more stability but lower returns. If you're earning 2% in a savings account, it would take 36 years for your money to double. The rule of 72 helps you weigh the potential reward against the risk empowering you to choose investments that align with your financial goals, risk tolerance, and time horizon. Number 2. Planning for retirement. As people get closer to retirement, they tend to shift from risky investments to safer options. Why? Because they don't have as much time to let their money recover from any losses. For example, a younger person might be comfortable with a 10% return on a high-risk stock that doubles their money every 7 years. However, someone near retirement might prefer a 2% return, knowing it will take longer to double but comes with much lower risk. The rule of 72 helps both types of investors, those aiming for rapid growth and those seeking stability. Number 3. Understanding inflation's impact. Inflation can quietly erode the purchasing power of your money over time. Using the rule of 72, you can estimate how long it will take for inflation to cut your buying power in half. For example, with an inflation rate of 3%, it would take about 24 years for your money to lose half its value. If inflation spikes to 6%, that time frame drops to just 12 years. This is a crucial factor in long-term financial planning. While your investments grow, inflation can diminish the real value of your returns. To counter inflation, it's essential to invest in assets that offer higher returns, like stocks or real estate. The power of compound interest. At the heart of the rule of 72 is the idea of compound interest. This is when the interest you earn gets added to your principal, and then you start earning interest on the new total. It's like a snowball effect. The longer it rolls, the bigger it gets. Think about it. If you have $1,000 earning 5% interest, after the first year, you'll have $1,050. In the second year, you're not just earning interest on your original $1,000, but on the $1,050. Over time, this makes a massive difference. The rule of 72 helps you understand the benefits of compound interest in a simple way. When the rule of 72 doesn't apply, while the rule of 72 is incredibly helpful, it's not perfect. The formula works best with interest rates between 5% and 10%. If you have a much higher or lower interest rate, the rule becomes less accurate. For example, if you're dealing with a 1% return, the actual doubling time is slightly different from what the rule of 72 predicts. But even then, the rule offers a good rough estimate. Also, the rule of 72 assumes that your interest rate stays consistent over time. In reality, interest rates can change, especially in volatile markets. For more precise calculations, it's always a good idea to use a compound interest calculator or consult with a financial advisor. That said, the rule of 72 remains a quick and easy mental shortcut for estimating investment growth. It's especially useful when you need to make fast decisions or compare different investment opportunities on the go. For everyday purposes, such as deciding between savings accounts or understanding how long your retirement fund might take to grow, the rule of 72 serves as a helpful tool. However, for long-term financial planning or more significant investments, relying solely on this rule could lead to miscalculations. When you're looking to maximize your returns or manage risks, more advanced strategies and tools should come into play. The rule of 72 is great for simple math, but your financial goals deserve a deeper dive, especially when planning for major life events like retirement, education, or buying a home. Always balance quick rules of thumb with thorough research and expert advice. In conclusion, the rule of 72 is a valuable tool that can help anyone understand the power of compound interest and the impact of inflation on their investments. It's a simple but powerful way to see how your money can grow over time. Remember, the earlier you start investing, the more time your money has to double. So, why not start planning today? If you found this video helpful, don't forget to give it a thumbs up, subscribe for more financial tips, and hit that notification bell so you never miss an update. Thanks for watching, and we will see you in the next video.